Hello, everyone, and welcome to today's episode of Macro Microscope. I'm Indrani Day, Head of Global Investment Research at FTSE Russell, the index business of London Stock Exchange Group, and I'm joined by John Dioufas, Director Data Stream in the London Stock Exchange Group. So today's topic is uncertainty and financial markets. I'll be the first speaker and I'll touch upon the uncertainty that arises because of the US presidential elections. And then I'm going to hand it over to John, who will take it on a more global scale from the macro backdrop. So, with that, let me jump into the slides. As always, a quick reminder that FTSE Russell is not an investment advisor, and everything said here is entirely for educational purposes. So, coming to the uncertainty and financial markets from the US presidential elections. Now, why the US? Well, certainly the US equity markets are more than 60% of the FTSE All World Index. US dollar is the reserve currency. So, what happens in the United States certainly has reverberations throughout the global economy and financial markets. And US presidential elections once every 4 years are obviously it's a big thing in the markets. So, this chart, what I'm showing here is the RVX is the implied volatility on the US small cap equities. So it's the implied volatility on the Russell 2000 index. And this graph is basically the average of the numbers in the last 3 elections. And what it shows is, like you see the vertical line at 0, that's the day of the election, and minus 30 meaning minus 90, excuse me, the 3 months leading up to the US elections and the 3 months after the US elections. So what this shows is the implied volatility in the US financial markets, the small cap equities. It's higher in the 90 days leading up to the elections. It falls immediately thereafter, and it's lower in the 3 months post-election. But it's also interesting if you see the sharp line, the line going sharply up in the last 15 days of the election, that tells you how much there is uncertainty in the markets. And this is not surprising because the outcome of the US presidential election means policies could change. What impact does it have on capital investment, hiring, expansion, all those kind of things. So you see this playing out in the volatility in the equity space. Now, what happens on the return side of the US equity markets? Now, we all know risk and return are two sides of the same coin. Return and risk have an inverse relationship. So we see the same pattern really playing out in the equity returns. The pre-election 3-month period returns and the post-election 3-month period returns. The post-election 3-month period is almost double that of the 3 months prior to the election. These are all numbers on an annualized basis. On an annualized basis, 3 months post-election is north of 9 percentage points. The 3-month pre-election is just under 5 percentage points. And I should say that these are the averages of all the data around the elections since 1980. So going back quite a bit in time. So this returns picking up immediately after the election, volatility dropping after the election. It tells you the uncertainty that was there in the market leading up to the elections. And it's almost like a sigh of relief post elections. And, companies getting back into business as they know more about the policies and what direction things are going to take. And the same thing you also do see in the returns in the 4-year presidential cycle. Typically, the first 1 year under a new president has the highest return. The first 1 year in this 4-year presidential election, cycle, the first year typically has returns more than 18 percentage points. The average in a 4-year period is about 15 percentage points, which also shows that it plays itself out over the entire 4-year presidential term. The first year, right after the elections are over, there is more certainty. The uncertainty is behind us at that point, and given the certainty, things generally improve, and that shows itself in the returns. Now, with that, I am going to hand it over to John.
Very good lead up to where we're getting to with macro uncertainty. So certainly at this moment in time, and in fact this year, there have been some large elections that have taken place this year. You think about the UK elections, South African elections, the Indian elections. and of course the US elections upcoming. But we've also seen an introduction of more macro uncertainty in the last couple of weeks. And what I did for this one, Indrani, is I went into a Workspace product and did a quick analysis, starting from the big non-farm payrolls economic surprise on the 4th of October. And I looked at all what we consider to be extraordinary economic surprises. So a normal economic surprise is basically defined as when the data release is different from what the market consensus was, right? And that can happen relatively frequently, It's almost expected sometimes, I think, in terms of the polling industry. But an extraordinary economic surprise is when the data that's been released is so different from the market consensus that it's either above the maximum range of that sample size or actually below the minimum range of that sample size. So when I did this analysis, what I wanted to do was try work out how many extraordinary surprises have there been since that non-farm payrolls number, and of course the private payrolls number that comes out at the same time. And upon completion of that analysis on the 14th of October, I recognized that for those 7 working days, we had 40 extraordinary economic surprises. And those 40 extraordinary economic surprises were across 18 different countries, 18 different domestic markets. And when you look at the economic indicators or the categories of economic indicator that those extraordinary economic surprises took place in, it was a large variety. We had some in the crude oil space. We had industrial production and manufacturing production. We also saw large variances in the retail sales, inflation, and of course in the employment numbers themselves. And I think the next question we have to ask ourselves is, what does that mean? What do we see the different authorities trying to do? So I went to the interest rate probabilities model that LSEG has, where we use the market pricing of interest rate curves to predict the next actions of a central bank at its monetary policy meeting. We carry the most probable action and also the least probable action. And before the non-farm payrolls came out the way they were, most people would have agreed that the most probable action for the Federal Reserve would have been a 50 basis point cut, and the least probable action would have been a 25 basis point cut. Subsequent to that non-farm payrolls number, which shows the US labor market to be in rude health, and also the other economic surprises that we've seen take place in the market, we now see, as well as of the 14th, that the most probable action for the Fed is a 25 basis point cut, and the least probable action is that actually hold rates where they currently are. This is a significant change in terms of what the market is pricing in now, as opposed to what the market might have been pricing in a few weeks ago. So what we basically see is this macro uncertainty has also led to monetary policy divergence as each central bank wrestles with its own unique economic situation as it tries to find the correct route to come out of a sort of increased level of interest rates with doing as little as possible damage to their domestic markets. Thank you very much, everyone, for joining today's call. Indrani, over to you. Thank you.
That concludes today's episode of Macro Microscope on uncertainty and financial markets. Thank you all for joining. Bye for now.
Bye-bye.